A 64-year-old man is about to lose over $200,000, not because of a market crash, not because of a bad investment, but because of one retirement decision. And the worst part is, he thinks he is doing the right thing. If you are saving for retirement, there is a high chance you are about to make the same mistake. His name is Dave. Dave is not careless. He's not irresponsible. He did everything right. He worked for 38 years. He consistently invested into his 401k, and he built over $1.1 million in retirement savings, including his traditional IRA. He skipped vacations. He delayed gratification. He trusted the system. And then one evening, standing in his backyard, his neighbor said Roth conversions are dead now. The new tax law killed them. Dave believed him. He stopped his plan. And that one decision could cost him between $180,000 and $240,000 over the next 20 years. Not instantly, but slowly, through taxes. So let me say this clearly. Roth conversions are not dead. In fact, for many people, they may be more valuable right now than they have been in years. But to understand that, you need to understand how retirement taxes really work. The confusion started when tax rates became permanent. Earlier, people believed taxes would increase after 2025. So advisors told everyone to convert now before taxes go up. But when rates stayed the same, people assumed there was no urgency and no need to convert. And that is the mistake. Because this strategy was never only about timing. It is about control. A traditional account means you save tax now and pay later. A Roth account means you pay tax now and never again. A Roth conversion simply moves money from taxable later to tax-free forever. So the real question is this: will your taxes be higher later or lower? Now here is what most people miss. Retirement taxes do not come from one place. They come from multiple directions. First, there is the required minimum distribution problem. At age 73, the government forces you to withdraw money every year. More withdrawal means more tax, and you have no control. Second, higher income in retirement can increase your Medicare costs. This can quietly cost thousands of dollars every year. Third, up to 85% of your Social Security income can become taxable depending on your total income. Most people do not expect this. Fourth, if your children inherit your retirement account, they may have to withdraw it within 10 years, which can create a huge tax burden for them. Fifth, future tax risk. Governments change rules. Taxes can increase. Waiting always has risk, and a Roth conversion helps reduce all of these problems. Now let's go back to Dave. If Dave does nothing, his money continues to grow, but so does his tax bill. Over time, he could end up paying around $400,000 in total taxes. But if Dave converts slowly over time, he pays taxes in a controlled way, reduces future withdrawals, and lowers his total tax burden. In that case, his total tax could be closer to $200,000. That is a difference of about $200,000 saved. The new tax law did not kill this strategy. It actually made planning easier, because now you can plan over multiple years with more clarity and confidence. Most people ask, should I convert? But the better question is, what will it cost me if I do nothing? Because doing nothing also has a cost. Roth conversions are not dead, but bad advice is everywhere. One wrong decision can cost you hundreds of thousands of dollars. One smart decision can save it. So do not follow random opinions. Understand the strategy. Because in retirement, it is not about how much you make. It is about how much you keep. Let me tell you about Margaret. Margaret is 68 years old. She lives in Florida. She retired 3 years ago feeling great about her finances. She had $450,000 in her traditional IRA. She had Social Security coming in at $22,000 a year. She thought she was set. Then age 73 arrived. Her first required minimum distribution was $41,000. She did not need that money. She had plenty in savings. But it did not matter. The IRS does not care if you need it or not. That $41,000 forced withdrawal combined with her Social Security pushed her into a bracket she never expected. And suddenly, 85% of her Social Security became taxable income. She called her accountant. She said, "I do not understand. I thought Social Security was tax-free." Her accountant said, "It is up to a certain income level. You cross that level." That year alone, she lost over $3,000 she never expected. And every year after that, the same problem getting bigger because her required minimum distribution grows every year whether she likes it or not. Margaret did not do anything wrong. She just never saw the trap coming. And this is the part most people never see coming. It is survival. I want you to picture your traditional IRA as a business. You own 70 to 80% of it. You did the work. You took the risk. You made the contributions every year for decades. But you have a silent business partner. His name is the IRS. and he owns somewhere between 20 and 37% of everything inside that account. He has never worked a single day for it. He has never taken a single risk, but his ownership stake is locked in by law. And here is the part that makes this even worse. Every year your account grows, his share grows too. You are doing all the compounding, and so is he. A Roth conversion is the decision to buy out your silent partner. You pay him his share today at today's price. And from that point forward, all future growth belongs entirely to you. That is it. That is the whole concept. Now you understand why it matters. Now I know what some of you are thinking. You are thinking, okay, but if I convert, I have to pay taxes now. That is real money leaving my pocket today. How do I know it is worth it? That is a fair question. And here is how to think about it. Imagine you are buying a house and someone gives you two options. Option one, you pay a small property tax now and the house is yours forever. No more taxes, ever. It grows in value for 20 years and you never pay another cent to the government on it. Option two, you pay no tax now. But every year, the government calculates the current value of your house and forces you to pay tax on a portion of it, whether you sold it or not, whether you needed the money or not, forever. Which option do you choose? Almost everyone says option one. That is a Roth conversion. The question is never really whether to pay taxes. You will pay taxes either way. The only question is when, at what rate, and on how much growth. And when you run the math honestly, paying the smaller tax now on the original amount almost always beats paying the larger tax later on a much bigger number. That is the trade. And for most people reading this right now, it is a trade worth making. Let me give you a number that will stick with you. Across the United States right now, there is approximately $15 trillion sitting in traditional IRA and 401k accounts. Every single dollar of that money is pre-tax. That means somewhere between $3 and $5 trillion of it already belongs to the government. It is just sitting there, waiting to be collected. And the government collects it in one of two ways. Either you plan your withdrawal strategically, converting at lower rates, in years when your income is lower, in amounts that keep you in favorable brackets. Or the government forces you to take it through required minimum distributions at whatever bracket you happen to be in at age 73, 75, or 80. With no flexibility, no control, no strategy. One of those paths is expensive. One of them is devastating. The people who understand this early enough get to choose their path. The people who hear that Roth conversions are dead and stop planning are handing that choice to the IRS. And the IRS will always choose the path that costs you the most. Here is something I want you to hear before we get to the action steps. This is not complicated information. It does not require a finance degree. It does not require you to be a numbers person. It does not require anything except the willingness to sit down, look at your actual situation, honestly, and ask the right questions. The people who retire comfortably and the people who get crushed by taxes in their 70s are often not that different in how much they earned or how much they saved. The difference is almost always one thing. Someone showed them the picture early enough to do something about it. Dave had $1.1 million. He saved for 38 years. He did everything the system told him to do, but nobody ever showed him what the tax picture looked like at 73. Nobody ever ran the two scenarios side by side. Nobody ever sat down with him and said, here's what happens if you do nothing. And here's what happens if you are watching this video. That means someone is showing you the picture right now. What you do with it is entirely up to you, but the window does not stay open forever. Required minimum distributions do not care about your plans. They start at 73 whether you are ready or not. The best retirement decisions are made in your late 50s and early 60s, when the balance is large enough to matter and the window is still open wide enough to act. If you are in that window right now, this is your moment. Do not be Dave standing at the fence. Be the person who saw the video, understood the math, and made the call.